Hello and welcome to Accommodate Unplugged on Tuesday, the 15th of March 2022. Terry Sheehan's on the US East Coast and I'm Jeremy Hawkins in London. The Ukraine crisis might have tempered some rate hike speculation, at least for a while, but a less accommodative twist from the ECB last week, together with near certain tightenings from both the Fed and the Bank of England over the next couple of days, mean that, with a few notable exceptions, the central bank's policy hawks remain in the ascendancy. Financial markets clearly remain worried about the inflation outlook, and it's no coincidence that any hint that the war in Ukraine might be coming to an end is immediately met with a rise in government bond yields. Not surprisingly, energy markets are currently hugely volatile, making it all the more difficult to determine where inflation might peak. But given what's already in the pipeline due to the ever-lengthening sanctions on Russia, it's certain to be a good deal higher than seemed probable just a few weeks ago. For what it's worth, the UK's National Institute of Economic and Social Research thinks the conflict could knock the best part of $1 trillion or so off global GDP and add 3 percentage points to world inflation. But it's really anyone's guess. So for some central banks, it may be more sensible to deliver a series of small changes to official interest rates rather than make fewer but more aggressive moves that boost the risk of recession. But it's a very hard call for all the monetary authorities to make at the moment. In any event, achieving a soft landing ain't going to be easy. Anyway, ahead of Wednesday's FOMC announcement, we heard last week that US inflation hit another 40-year high, and on many measures, inflation expectations are climbing steeply. So over to Terry and the key question, what's the Fed going to do about it?
It is really a tough call. Right now, among the voters, as I calculate it, there is probably a slight bias toward a 50 basis point increase at tomorrow's meeting. The Fed's facing a deepening dilemma in terms of clearly the inflation data is not getting better in the near term. And with the war in Ukraine, it might not get better anytime in the immediate outlook. So they are under a lot of pressure to address inflationary pressures and maintain their credibility as an inflation fighter. On the other hand, there are signs that the economy may be softening. Early forecasts for first quarter GDP are running roughly around 1% right now, significant drop from the 7% in the prior quarter. So we're really, the Fed's problem is not cutting off the expansion while taking care of inflation. Clearly, they've got strong data for the labor market, at least up till now. So really, they've got a real problem on their hands in making their decision tomorrow.
So, I mean, I guess Ukraine is going to get mentioned to a fair amount in what Jay Powell and co have to say tomorrow. Do you think they might try and use all the uncertainties associated with what ultimately the crisis there is going to mean for US, Europe, whatever, for the global economy, as a means of perhaps not introducing some measures now and giving themselves the opportunity to defer them slightly? Or do you think it really is, well, look, we're going to have to do something now or our credibility is going to go down the tubes?
Certainly, they're going to have a hard time assessing just what the risk from the conflict in Ukraine presents to the U.S. economy. It's, physically relatively far removed, but these are our NATO allies who are facing the problems associated with Ukraine, and we're going to have to support that. But is this a direct risk to the U.S. economy, to the stability of our financial markets? It is entirely possible that policymakers will want a little more clarity before they start aggressively moving rates.
So, I mean, do you think it's the case they might say, well, okay, well, look, we're going to do 25 basis points this week because we haven't really got a clue what's going on in the real world at the moment because nobody else has either. And then perhaps consider, if things do start settling down a little bit in Ukraine, doing 50 points at the next meeting.
That's possible. The other possibility is they could do 25 basis points now, wait a couple of weeks and do an intermeeting move to kind of hurry the process along, and then 25 basis points at the next meeting. So they might judge the immediate impact of a 25 basis point increase. If it doesn't seem to be enough, they could do an intermediate move, but they don't like to do that because that presents a perception that there's something panicky about what the Fed's doing, or that they're responding to some sort of exogenous event. So I think tomorrow it's, a rough, I mean, it's really about equal right now. And I wish I could be more definitive about whether they do 25 and worry more about the risks to the economic outlook, or feel a need to address the inflation situation with a 50 basis points, and after which they could go to 25 increments.
All right. So dot plots, people get agitated, at least it's been my all day anyway. They just get very agitated about the dot plots and everything it tells us about what the Fed's going to do. It doesn't actually mean a great deal. Do you think this time around the dot plot, in actual fact, because there is simply so much uncertainty out there, it doesn't really tell you a great deal in the first place?
I think what it's going to tell us, if anything, is that policymakers have a variety of views on what the outlook is. I think it's going to be a little more spread out than it usually is, depending on how severe people see the risks coming up. Policymakers always warn that whatever you see in the forecast is just forecasts as of this moment, based on the data they have. It is not a promise of future moves in rates. So I think Powell is going to hammer on that point in his press briefing tomorrow, because I think the forecasts are going to be a little more diverse than usual, and probably be in where their median is below where they were before. So people are going to be wondering if they're really anticipating a deterioration in conditions or not.
It's interesting. I think it's probably true. A lot of central banks at the moment, we saw, like on the ECB in a minute, but the ECB last week, very much widening split views on what on earth they should be doing. So it is a problem for all central banks at the moment, isn't it? I saw actually quickly on the University of Michigan, because we saw, just playing the sort of devil's advocate, I guess, here, should they be tightening in the first place? We saw a big fall there. Remember, was it its lowest level since 2011, something like that?
Yes.
On their preliminary estimate. Is that important, or is it just one of these things which swings around too much that doesn't really tell us too much?
Actually, it's not a really volatile indicator, but I think what it speaks to is increasing concerns about the outlook for the US labor market, and for how inflation is going to eat away at the earnings gains that have happened in the last year or so. I don't think it means that we're going to see a sudden drop in consumer spending. Consumers are actually getting fairly large tax refunds this year, and they're arriving earlier than they did last year. So that's a good thing for the outlook. But they're not getting stimulus money, which is a bad thing for the outlook. So I am not overly concerned about the low readings in consumer confidence. I think we'll see some upward revision, because that first preliminary reading was taken just as the war in Ukraine was starting, and I'm sure it had a big negative impact for the early reporters. But consumers are gloomy, and I think it probably bodes poorly for the political outlook more than it does for the economic one.
Interesting. Okay. Anything else from your part of the world you'd like to put in?
No, we're carefully watching the early reports on manufacturing activity. We got the New York Fed report out this morning, and that went back into negative territory. So the March data on manufacturing could be worse than originally thought. That would be bad. So I think what we're really watching for now is tomorrow's retail sales report, which will be for February, again, before the Ukraine situation really started. But that will have a lot to do with how people perceive how the overall quarter will perform.
Okay, and let me ask you one last question before I shift across to my bit of the world. Europe obviously much more directly impacted by what's going on in Ukraine than across your side of the water, but over here there does appear to be more concerns about the possibility of a recession, particularly as and when we start to see that the ECB begin to adopt a less accommodative policy or even tightening. Is the R word even featuring on your side yet?
Not yet. There's some rumblings around the margins, but there usually aren't there? But there is concern that we are going to return to the situation where we had very slow growth for a very long time. And if it's not outright recession, it's going to look bad compared to the last year or two of growth as we recovered from the economic slowdown that preceded the recession brought on by the pandemic.
Difficult times. Who would be a policymaker, eh? Okay, great. Thanks, Terry. Okay, well, from my part of the world, ECB then really very much kind of reflecting what Terry was talking about with regards to the Fed. Last week at their meeting, they ultimately came out with, well, an interesting compromise between those wanting to wait before accelerating the end of quantitative easing, just on worries about the hit to the real economy from the Ukraine crisis, and those at the other end of the spectrum who really wanted a more immediate action to combat inflation before it gets further out of hand. Now, what they actually did at the end of the day, financial marks took as being surprisingly hawkish, but I think if you actually stand back and look at it, in reality, it was hardly aggressive. Now, essentially, they've trimmed the quantitative easing plan for the second quarter. That was originally supposed to be 120 billion euros. That's now been cut to 90 billion euros. And from what they're saying, they're clearly hoping to terminate the overall quantitative easing program in the third quarter. However, there was no QE target set for the third quarter, and its phasing out, if it's going to happen, is going to be dependent on how the data come in. So essentially, for the time being at least, quantitative easing is still open-ended, which is a big issue. Moreover, and at least as importantly, they've really gone out of their way to de-link the end of quantitative easing from an increase in interest rates. That now is expected to happen only, to quote them, sometime after asset sales are completed. Under the previous guidance, forward guidance we had with quantitative easing, is expected to end, to quote, shortly before rates were raised. So in other words, even when quantitative easing finally finishes, and that may or may not be in the third quarter of this year, a rate hike could still be several months away. So they've given themselves increased flexibility, which I guess in these current times is no bad thing to have. But it does probably mean that certainly, what Terry was talking about in terms of rate hikes across the states, they're going to see a significant widening of the yield differentials between US assets and European assets, which ultimately at least ought to be a plus point, presumably, as far as the dollar is concerned. In terms of the numbers, just try and get some kind of idea of what the ECB thinks that the Ukraine hit. 2022, the GDP forecast, they've taken 0.5 percentage points off that. So it was 4.2% forecast at the December meeting. That's now been cut to 3.7%. Again, to some extent, it's almost back of the envelope stuff because no one's really too sure what's going to happen at the moment. But it gives you an idea of the fact that they are looking at certainly a good deal softer growth as far as this year is concerned. Next couple of years have only taken 0.1 percentage point off, so presumably they're looking for the main hit to come through in 2022. The inflation side, and so as Terry was talking about, I see probably at least initial increase in their early forecasts for US inflation. As far as the ECB is concerned, well, they're now looking for inflation in 2022 of 5.1%. That's almost a full 2 percentage points above what they were anticipating last time round. And again, just to reiterate, as we've both been saying, it really does present the policymakers as a major problem. What you look at, you concentrate upon inflation, which is going to be a good deal harder than they previously thought, or do they concentrate upon trying to support the real economy, which as far as Europe's concerned anyway, could at least face the real prospect of some kind of recession, perhaps towards the back end of this quarter. So this year, I should say. Indeed, with regards to that, we had a new survey out from Europe earlier on this morning from Germany, the ZEW survey, and that was notable for seeing the sharpest ever drop in the expectations component. Now, this, it should be just reiterated, is just a survey of what analysts are thinking. So it's no direct linkage into industry or consumers, but nonetheless, to see such a sharp turnaround in this index really does suggest that the German analysts are particularly worried about just how big an impact the Ukraine crisis is going to have on overall economic activity as far as the Eurozone is concerned. What else have we got in terms of upcoming meetings? Bank of England, of course, meets on Thursday. That's been somewhat ahead of the pack in as much as we've already had 2 consecutive rate rises over here in their previous 2 meetings. And to all intents and purposes, it looks, to the extent everything can look certain, as if there will be a hat trick of rate hikes once we get to Thursday. Essentially, we've got pretty strong economy. Most of the economic numbers have been outperforming. Economy's economic consensus divergence index has been well above 0 now for pretty well all of February and into the beginning of March as well. So the economy has been outperforming. The inflation numbers, of course, been coming on the high side. Wage surveys out of the Bank of England itself have suggested they're starting to respond to rising prices as well. And also, of course, at the last meeting in February, some 4 of the 9 MPC members wanted a 50 basis point hike at that time, which would have put bank rate at 0.75%. So it does seem pretty certain, I must say, that we will see a tightening coming through on Thursday. Personally, I'd go along with the market consensus in looking for 25 basis points, really because of Ukraine. I think absent of Ukraine, they might well have decided to do a full 50 basis points, because given what's happening to pipeline inflation pressures in the UK, along with Europe, we are going to see the inflation numbers forecast previously overshot by some significant way. But given the uncertainty surrounding Ukraine and its impact on real economic activity, I suspect they'll go cautious this time round with 25 basis points and then have another look. Financial market counting a full 2% base rate, or bank rate, I should say, by the back end of this year. Back in February, the B of E made noises to the effect that they thought that really was too aggressive. And they pointed to the forecast, which suggested if we were to see that, then inflation would actually be below its 2% forecast over the medium term. However, in light of what's happening to particularly energy prices, and indeed most commodity prices since then, clearly the starting point for inflation now is going to be a good deal higher than it was at the last meeting. So 2% might even prove to be a little bit on the low side. What else have we got to mention in terms of rate move, central bank stuff? Bank of Canada, their last meeting, beginning of the month, they hiked by 25 basis points, the overnight target rate going up to 0.5%, very much in line with expectations. And the BOC also signalled that it expects to see further interest rate hikes in the pipeline. Didn't do anything in terms of changing their reinvestment policy on quantitative easing, but that's probably going to become about sooner rather or later. And certainly the recent numbers out of Canada have been, to some extent, mirroring what's been across the border in the States. The February employment report was extremely strong. It saw the largest increase in payrolls there since September 2020. And the inflation numbers, of course, have been extremely high. And indeed, tomorrow on Wednesday, we'll get another update for February. And that's expected to see the headline rate up to 5.5% after 5.1%. So to all intents and purposes, Bank of Canada still looks to be very much amongst the tightening crew of central banks. By contrast, and it's always nice to have a contrast, BOJ, they'll be meeting at the end of this week. And if you're looking for a central bank, which is still reluctant to tighten, I guess you've got the Reserve Bank of Australia on one hand, but you've also got the Bank of Japan. Indeed, just last week, the governor was essentially ruling out withdrawing us any kind of stimulus, let alone tightening policy, due to an increase in inflation driven by fuel costs. As far as they're concerned, again, just like the RBA, they really want to wait to be sure that wages growth is picked up and it's picked up sustainably. And at the moment, that's not really happening. And indeed, inflation expectations in Japan, despite what we've seen occurring with oil prices and so on, they still remain pretty low. So bottom line, it still seems that, at least as far as this Friday is going to be concerned anyway, there's going to be no change of policy whatsoever, or certainly not of significance. China, I should mention China, well, really much to do with what's going on with inflation and COVID. China, indeed, a lot of Asia at the moment is offering a reminder that you can't ignore COVID because it hasn't gone away yet, with all its potential implications for yet more inflation. Out of China, we've seen indeed a lot of Asia. We've got record COVID cases out there now, notably in China to the extent that I think as of yesterday, at least 2 of the major Chinese cities were in complete lockdown, affecting the best part of 51 million people. Now, this is clearly going to have negative implications for supply chains, the same sort of things we're seeing coming out the likes of Vietnam, Malaysia as well, and also particular South Korea. And so it's not only good news for supply chains or indeed ultimately input prices as well. So there's still a lot going on in the world at the moment, quite apart from what's happening in Ukraine, which suggests that inflation numbers are going to remain high for quite a while yet. We do also hear Accommodative cover Taiwan, and there'll be a central bank meeting there on Thursday too. Basically, the central bank looking to tighten. They dropped fairly broad hints at their last meeting in December. The central bank has a quarterly meeting. Market census is that they won't actually do it at this particular meeting, but they may well drop additional clues. The fact that it's just a matter of time before we see interest rates going back up again. Okay, then I think that's probably just about it in terms of run round from the central banks. Anything else from you, Terry, before we wind it up?
Not for me.
Okie dokie. Well, that's it for now then. I suppose you've got to say it's really easy for central bankers to make policy decisions. Just try asking the Russian central bank, and they're due to make their next announcement on Friday as well. And the current environment clearly makes it all the more complicated. For now, inflation, though, clearly seems to be the main concern, but bear in mind that could change quickly once the full effects of the war on the global real economy become apparent, and indeed as financial strains continue to build. So be sure to keep up to date with all of the key policy moves and economic data in Accommodate's global economic calendar. On behalf of Terry and myself, thanks as ever for listening. We hope to see you next time. Bye for now.